So you know that Rolling Stones song, "Gimme Shelter," right? So to quote that song, it says, it starts out, "A storm is threatening my very life today. If I don't get some shelter, ooh yeah, I'm gonna fade away." Now, clearly, I sound nothing at all like Mick Jagger, and so resisting the temptation to actually break into song as I just simply read those lyrics. The reality is that beyond giving you shelter, your home also provides a variety of tax benefits that we're going to be talking about in this segment of Dollars and Cents. So your home is certainly one of the biggest investments, right, that most people make in their life. And typically, they don't have the cash stashed away to just, put a bunch of cash on it. They typically borrow money, right? And so that loan to purchase a home takes the form of a mortgage, where the home is used as security for that loan. Now, the interest on that mortgage then is actually tax deductible. So in order to qualify for that, then the home that we're talking about has to be either your main home, your primary residence, but it also can apply to a second home as well. And in order for the interest to qualify, then it has to be that main home, that second home. You can also borrow against an existing home if you use the proceeds to ultimately improve the home itself. Some limits in terms of how much can get deducted, and or how much one can borrow and still deduct the interest. That limit today, mortgage amounts up to $750,000. So pretty big mortgage, or the interest on what would be a pretty big mortgage, all of that interest would wind up getting deducted. Now, the key piece to this and being able to deduct your mortgage interest, it does require you to go through the process of itemizing your deductions, right? So that process where you sort of total up all your itemized deductions, the name of the game there is then that you have to do better than the standard deduction. So the standard deduction is what you get as your deduction under the tax code. You itemize your deductions when you think you're going to do better than that. Now, what has happened of late, particularly post-2017, is the standard deduction has gone up quite a bit. The standard deduction for a married couple for tax year 2024 is over $29,000, $29,200. Single taxpayer, it is $14,600. So your total of your mortgage interest, along with things like charity, real estate taxes, things like that, have all got to add up to be more than that standard deduction in order for it to make sense to go ahead and itemize your deductions. So, but important to kind of go through that exercise and make sure, although given how much higher those standard deduction amounts are, that kind of only really applies to about 10% of the population. But if you have a mortgage, the interest on that is deductible, and ultimately that's one of the benefits of owning a home, because with that you can also then, particularly if you're trying to itemize your deductions, so you can use the mortgage interest, the interest on the loan on the house, but then you can also use the amount that you paid for your state and local real estate taxes. Now, if you say that out loud, it's state and local real estate taxes. That's where the acronym SALT comes from. Okay. And we're hearing a lot about this SALT acronym because right now your ability to deduct your state and local real estate taxes is limited to $10,000. Now, in that category is more than just real estate taxes. It's income taxes if you're in a state where you pay income taxes. But again, that's why it's state and local taxes. So that's technically what that SALT definition applies to. The limit there is $10,000, or the cap, if you will. So that SALT cap of $10,000 limits your ability to deduct your home real estate taxes or even your state income tax. Getting a lot of discussion in Washington, D.C. about changing that cap, widely expected to be adjusted upward. So an opportunity to write off potentially more of or a larger share of your real estate taxes. So stay tuned on that one. But that's another way in which owning a home can help on your tax return. In addition, of course, if you are self-employed and use part of your home as your office, you can deduct expenses related to a home office. Now, there's a lot of catches in this one. But first and foremost, it has to be self-employment income. W-2 income does not count and does not allow you to take this type of home office deduction. Beyond that, the portion of your home that you are using for your home office has to be, and the test is exclusively and regularly used for business purposes. And I guess this is where things kind of get tricky, right? Because if you're working on the kitchen table, I don't think that's exclusively used for business purposes, right? You probably eat there as well. And then that would disqualify that home office deduction for you sitting there at the kitchen table. So there's a simplified method that they give on this one where you get to use a rate of $5 a square foot for a portion of your home not to exceed 300 square feet. And in order to do that, of course, if you're doing that and you've got self-employed income, then you're filing Schedule C, which is where that home office deduction for your home then would show up. Bottom line on that one, make sure you're careful as the rules on this one are very specific in order to take that deduction. So those are the main deductions involving your home. Beyond deductions, which simply subtract from your income, there's also a number of tax credits. And tax credits, you have to remember, are much more valuable than deductions because tax credits lower your tax bill on a dollar-for-dollar basis. So among those tax credits that are available are some various energy efficient types of improvements that allow for a tax credit of up to like $3,200 for the year. Generally equals 30% of the cost of allowed improvements such as insulation, windows, doors, water heaters, things like that. Be aware that in this category there's different sublimits on the type of improvement that you're doing. So like if you're replacing your windows, there's a sublimit of you can't do more than $600. $2,000 for a heat pump, things like that. So again, make sure you're kind of working this one very carefully. The biggest of those energy efficient tax credits, of course, is the solar credits, right? If you're putting up solar panels on your home, there's no financial limit on that. You can write off as much as you can or as much as the cost was, subject to the limit of 30%. You can only write off 30% of the cost of those solar panels, but it can be for whatever amount. So if your solar panels cost you $50,000, you could write off 30% of that number. So that's a pretty significant credit, and there's no sort of limit to that. So if the write-off is $10,000, you get the full 10. If it's 12, you get the full 12, etc. So those are some of the different tax credits that can also apply by virtue of owning a home. And then one of the kind of the more unique things about a home is that you actually get to exclude the gain when you sell it. Particularly now, this applies to your primary residence. It applies if it was your primary residence 2 of the last 5 years. And what that means is that if you sell your home, your primary residence, that at least it was for 2 of the last 5 years, then you can exclude up to $500,000 of gain as a married couple. Maybe you saw that in the appreciation of your home. Now, remember, gain, you got to look at your net sales price, right, that you actually got when you sold the house versus what you bought the house for, plus any of the improvements that you put in along the way. So the difference between those numbers, assuming that the house sold for more, that is the gain. That gain is excluded up to $500,000. So a very unique, that home seller's capital gain exclusion is pretty unique in the tax code, where you can sell an appreciated asset and not actually have to pay any taxes on the sale of that. So certainly a lot of ways in which your home is more than just shelter. It is, in fact, helps you on your tax return as well. With that, we're going to start to wrap it on up and get on out of here. Thank you for listening to this week's episode of Dollars and Cents. If you have any questions about anything that we talked about, please reach out to us, courtesy of our website at nelsonfinancialplanning.com. While there, if you want to schedule an absolutely free conversation to talk about your particular financial situation, we'd be happy to get that on the calendar as well. Those consultations are done free of charge at all times, and also a great way to score a free copy of our book, Next Gen Dollars and Cents, as well. With that, we're going to conclude this week's episode of Dollars and Cents. This is Joel Garris of Nelson Financial Planning.